as Jackie mentioned, there's a lot going on in private credit. The asset class has grown to very rapidly over the last few years, but an extended period really. It's estimated at US dollars 3 trillion, and it's been labelled as a bubble. And I actually just think of what Darren was saying. I mean, really, credit and credit cycles is historically well established, and we're pretty used to that. But the recent growth of private credit's been labelled as a bubble. We've had a few prominent defaults, a flood of evergreen products, and the regulators are getting focused on it. And it wasn't that long ago that we had the global financial crisis, really. So locally, ASIC has come out with 2 papers, 814 and 820. And the first paper really looked at the size of the market and identified some shortcomings and positives about private credit. It said that the local market's about 200 billion Australian dollars in size. About half of that is real estate financed. They did set out 10 principles for future guidance, but we won't go into those, and this comes up in question time. But more recently, as you probably all know, the hype has been somewhat offset by media reports of significant redemptions from some large US private debt funds. And that was apparently sparked by the SaaS apocalypse, that is the concerns over the impact of artificial intelligence on software company valuations. But there are other reasons as well, which we could go into. In this panel, sorting the wheat from the chaff, I thought was something more related to the agricultural revolution, but we're going to try and uncover the facts here and where this asset class is heading in the next few years from a managed accounts point of view. I'm joined by an eminent and well-qualified panel, Darren Beesley, who's the Chief Investment Officer at Evidentia Group, and Michael Karagianis, who's Head of Wealth at JANA. There are 3 main sections that we're going to go through, and then we'll have Q&A. So firstly, we'll define private credit and discuss appropriate asset allocations for typical managed accounts investors. And secondly, we'll discuss these recent defaults in the sector, which are colloquially called cockroaches, which was a comment made by Jamie Dimon, the Chairman and CEO of JP Morgan Chase, late last year. And we're going to try and work out whether these are isolated cases or the beginnings of systemic collapse in the sector. The panel will also address how effective investment processes can avoid these bad investments and find good ones in the construction of robust portfolios. And then, hopefully we'll have time, we'll consider the current market valuations and factors that are likely to drive returns over the next few years. Okay, Michael, start with the first question, please. From a portfolio construction perspective, how do you define private credit, and why has it been so attractive to Australian wholesale and retail investors?
Yeah, so the definition of private credit in one sentence is actually quite simple. It's lending by non-banks to private public companies. And it really derives from the period of the GFC, when in the aftermath of the GFC, there was an increase in banking regulation amongst many developed economies, led by the US, which really clamped down on the amount of lending that was occurring into particularly the mid-market corporate sector. A lot of the large corporates, would tend to avail themselves of the more conventional public markets anyway, high yield market, for example, but that lending that occurred to the mid-market was a source of problem. And that regulatory change really meant that they had to find alternative sources of credit. And so you see really since about 2012, thereabouts, a significant escalation in private credit activity. And more recently, you've seen it in Australia as well. And a lot of that has been driven by the banks stepping out of that market. It's interesting, you talk about where the private credit market is at the present time. I mean, 2.5 trillion, wherever. No one's really quite sure where it is globally, but probably around that quantum, expected to maybe double over the course of the next few years. When you look at the overall leverage that's occurring into the corporate sector, it doesn't actually look as speculative as that, because when you accommodate the fact that there's a lot less bank lending going on, you look at the numbers for the US, the actual proportion of total leverage at the corporate sector is actually not increased much at all. Just the mix of it's increased, and it's been this phenomena of private debt really taking over. Most recently, I think what has perhaps been a more concerning development has been the direction of private credit towards the wholesale, and in particular the retail market. We've seen that in the US, and some of the recent gating that's occurred has been very much associated with retail investors, and a mismatch between the underlying nature of these investments, which is illiquid. I mean, it's like private equity, private credit. I mean, you are really looking at investments that have a long future date, and you need to stick with it. They're not designed to provide liquidity. And of course, retail investors don't always understand that, and when you get trouble, they want to head to the door. And so that, I think, has been a recent phenomenon over the last few years in the US and more recently in Australia. And that's one thing I think ASIC is concerned about. It's certainly one thing that we've expressed some concerns about as well.
Okay, great. Darren, when you recommend allocations to private credit, if you do, as Evidentia Group, into a client's portfolio, what role is it really playing? And sort of following on from Michael there, why is it attractive? Why has it been attractive? And are there issues if advisors treat this asset class as defensive income?
Thanks, Nigel. Oh,
push that up again.
There is no switch. Hello. Thanks. So at Evidentia, we don't recommend putting illiquid assets within a managed account to start with. So that's a key thing to note first. We work closely with our partners, the advisors, to work with their clients to work out their liquidity budget. And then we separate all the illiquid stuff, wrap it in another wrapper, a private markets fund, and carve that out as a separate allocation. Because if we put it in a one-size-fits-all SMA, then you've got a retiree aggressively drawing down with the same illiquidity as a young accumulator who has all the illiquidity budget in the world. So there's the capacity to take illiquid assets on board, and there's the tolerance, and that can only be worked out by an advisor having the conversation with their client and working through their cash flows. So we don't consider that growth defensive is a terrible classification methodology anyway, but in the purposes of that framework, it's all classes growth. It serves an excellent role in portfolios, we believe, once that illiquidity budget is carved out. On the point about retail going into illiquid assets, totally agree. There's a lot of misunderstanding, particularly when there's liquid wrappers around illiquid assets or promises of monthly redemption windows. Oh, it's not that illiquid. I've got a monthly redemption window. Well, actually, the stuff in there could be locked up for years. There's a huge misunderstanding of what a redemption window means to what the actual look-through lock-up period could be. And that's why we don't put these things in an SMA, because that would break the thing. It has to sit outside, in our opinion. One more thing, I think education's a huge part of this. So to go into the private markets fund that we offer, the Evidentia Global Private Markets Fund, the advisor goes through an accreditation course to understand that it's quite likely at some stage this thing will be gated. That's a good thing. We're going to treat maybe we'll get into this later about the nature of gating, and that's kind of a good thing, but we make sure our investors aren't misled or misunderstand that this thing, even though it pays monthly redemptions, it may not one day. And that illiquidity reality is what people going into the fund should be aware of, and that means the investors are more stable when things get rough.
And Michael, I mean, for retirees that are seeking income, and you talk about the illiquidity budget, I mean, is it sort of investment that would be attractive in those sort of portfolios?
Yes, and certainly we view private credit as a really interesting and useful construct within a broad portfolio. Picking up some of the points that have just been made there, though, don't view it as defensive. It's not a defensive asset class. A lot of these investments are high yield by nature, which means that they are likely to have a higher default rate over time. They are illiquid, so don't expect that you're going to get a liquidity buffer out of this investment. This is a long-term investment. It may be appropriate for investors in pension phase if they still have a long runway, but don't expect that it's going to be part of the portfolio they're going to be able to draw down on anytime soon. I think one of the problems with what we're seeing over the last year or two in Australia and the rise of retail structures, and in particular, we've seen evergreen structures emerge, but we've also seen listed structures, listed investment companies trying to synthetically create liquidity. The underlying asset is liquid. If you want to get out in any volume, what you're really going to have to accept is substantial discounts on NAV. And a lot of investors, I think, will struggle with that. We just think, it's all about education and making people aware that it's probably not an ideal structure to put into a defensive part of the portfolio.
I guess the yields have been attractive. We've seen spreads come in investment grade credit. The defensive sort of fixed interest part of the portfolio hasn't been that attractive. And I think just thinking back to the last global financial crisis, not that I'm leading the debate here, returns were very attractive out of the non-mainstream areas. So, I mean, is that what we're seeing again today, Darren? Do you think that the returns are like a double-digit returns are being offered here?
Well, I'm a lot louder. It's just so diverse, so that it's we sit on the investment committee for our private markets fund. We partner with Wilshire. The deals that they bring come and that we see and we put in that fund range from almost IG like private, very high grade.
Say IG's investment grade.
Investment grade. And then you've got stuff that's very, very specialised, very niche, very complex that demands 12, 13% yield still today. So I think it's very hard to comment generally on the space. What I would say is that our observation is the large end of town, and which is typically leveraged buyouts, that's where you're seeing more of the warning signs. So if those warning signs are tight spreads, loose covenants, so covenants being the restrictions the lender puts on the borrower to reclaim assets if they do anything or if they're not performing, and leverage, I think that's all getting kind of worse in that big end of town. But once we go out of that and look at direct lending to mid-market America, there's a huge diverse set of industries, businesses that are still willing to pay a high yield because the lender is partnering with them, they're understanding their business, they're understanding their needs, and they're providing a service that the banks of the US refuse to deliver anymore. So I think it is about putting in the hard work into underwriting and providing debt to a niche space, and not just thinking this is one big pool of assets that capital goes in and capital goes out at one spread. It's more nuanced than that.
Okay.
Yeah, picking up on Darren's point there, I think there's a couple of really interesting points there. One, private credit is not homogeneous. Okay, it goes from relatively high quality senior debt, as we see in the public markets, through to subordinated debt, and then there's venture capital and so on. So you can get very speculative, and the yields you get will be reflective of that. So what you want to understand is that you are receiving a high yield, but there is probably a reason for that because of the nature of the underlying investment. So understand what you're investing in is absolutely critical in this space. Okay,
and so what's the sort of typical allocation would a balanced investor have to this sector, do you think? Is it strategic or opportunistic?
Well, I think you know, it depends really on the nature of the investor. So, for example, an endowment type investor, a family office that has a significant illiquidity budget, you know, we've seen cases where they might have 30-40% exposure to a well-diversified pool of private assets. And private credit is a significant proportion of that. Managed accounts, be very cautious about allocations from a managed account point of view. And for a retail investor, you know, again, very cautious about the magnitude of exposure, because do they really understand the nature of the investment? So, you know, it's hard to categorize what, you know, everyone should have on average, but I'd say to you, it really relates to understanding what their illiquidity budget is and their appetite for risk.
Can I just add?
Go ahead.
I've got a strong view on this. So we really want to partner with our clients who are wealth advisors and build a framework around their strategic advice framework. And that involves how to carve out an illiquidity budget for them. So I think the average is just a number. It means nothing. I think each individual end client, mum and dad, or young accumulator or retiree, has their own specific illiquidity budget. And we provide tools and a retirement simulator to allow them to have that conversation, empowered with research and tools to say, this is the right illiquidity budget for you.
Okay, great. So let's move on to cockroaches. Actually, where's our slide, Toby? All right, okay. It's not really a slide, it's an animation. Okay, so Michael, are the recent defaults, such as First Brands, Tricolour in the US, MFS in the UK, which have been highlighted in the media, are they isolated cases or reflecting deeper problems in the sector, as we saw in the global financial crisis?
It's one of the interesting observations in the private credit market at the present time, on that right-hand chart, and it might be a bit hard to see, but private credit's actually the left-hand bars there. That shows currently reported default rates. And what's interesting from that is it's actually exceptionally low, sitting around, I think, 1.5% of total loans. Now, that's reported. There is speculation that the actual true level of defaults in the private credit market at this point in time is maybe closer to 5%. And some of the reasons for that is that, as Darren pointed out, you know, one of the attractions of the private credit market is that the lender has the ability to negotiate the covenants, and that provides them an enormous amount of power in terms of negotiating these loans, and I think is one of the key protections that investors in private credit do have, provided they're going with the right private credit funds where those lenders are exercising it appropriately. But some of these covenants do actually allow a bit of flexibility in interpretation of default as well. So you get, for example, debt restructurings rather than reported as a default. There's an ability to restructure the debt, to change the terms and conditions of the debt. In the public market, that would be recognised as a default. In this market, it's not necessarily recognised as a default. Payment in kind is a concept that's developed where, you know, rather than paying the interest, they actually are allowed to capitalise it, not formally recognising it as a default. So these numbers are probably underrepresented at this point, but I'd still say in a historical context, the level of actual defaults occurring in the private credit market are not exceptionally high. There is certainly speculation when we talk about SaaS, for example. In the
I mean, sentiment has just changed so quickly that there's numbers that are in double digits being speculated about, even from investment banks, right?
Yeah, look, I think there's probably a bit of self-promotion here. We know, for example, there's a lot of hedge funds that are talking this up and basically sitting there and saying to investors, well, we'll buy the debt off you at, say, 65 cents in the dollar, and you know, hoping that the market's going to really accept that as a reasonable outcome. Where in reality, if you look at some of the recent events that we've seen, the market has actually ultimately cleared. Blue Hour is a case in point, where they gated their fund, but then ultimately allowed redemptions because they had negotiated a sale of assets, and those redemptions occurred very close to par. So in reality, I think what you're actually seeing is more of a liquidity problem in this space rather than a default problem at the moment. And the nature of the liquidity problem, as we were talking about before, is too many investors have been lured in based on the assumption that they could get out pretty much where they, when they wanted to, but the funds ultimately couldn't withstand those redemption calls when the tide turned, and the funds have had to be gated as a consequence.
Okay, good. Darren, so when your research team's reporting their due diligence on these funds, what are the early warning signs that you identify as a CIO, and how the portfolio's set up to diversify that risk?
Yeah, so as Michael's saying, once you're in private credit, you're in. So it's a bit late once you see defaults coming through to tap the exit button. On the way in, you want a margin of safety. So I think easy number to look at is the spreads. Then there's the covenants, and then there's the leverage. And so they're out of the four kind of measures of risk in private credit, the big ones, 3 of them you can know about going in, defaults you know about going out or stuck. So those 3 things are key. And when we first started doing this, spreads were much higher on the back of this 2022, 2023 blowout in spreads. You could pick up really good private credit, and you could often get secondary deals at 10% discounts on really nice mid-market diversified portfolio of loans. They in themselves are paying 11% yield. How could you say no, basically? So it was kind of easy back then. And we started off running this private equity, private credit portfolio, but we found ourselves overweighting private credit because it was just so attractive. I think wind forward the 3 or so years of this tightening, and now we're adding more private equity, not this discretionary top-down tilt, but just deal by deal, what we're seeing is looking better on the private equity side, where their borrowing costs are cheaper, the opportunities seem quite interesting, and then on the private credit side, things look tighter. So those entry signs on the way in are a little bit concerning. I honestly don't know whether the
that work being done by the Evidentia group, or is Wilshire doing that work for you guys?
Wilshire do most of the single asset work, and we as an investment committee talk about the broad asset allocation, the actual final due diligence sign off, and the allocation size. So it's a partnership in that way. But the access they bring to deals that we wouldn't be able to access otherwise as an Australian investor has been exceptional. So it's a solid partnership so far. Okay,
good. JANA, how do you address the operational due diligence, Michael?
Well, we only work with fund managers, and so our operational due diligence and investment due diligence is associated with the fund managers themselves, and getting an understanding as to, their experience in this asset class, the nature of the teams they have. So, if you invest in this asset class and you think that you're not going to get defaults in your loan book, then you're in the wrong asset class. This is an asset class that will have defaults. That's the nature of it. The question is, what is the proportion of the defaults? So how good is the due diligence that the fund manager has done in terms of entering into the deals in the first place? Do they have access to the right deals? So different fund managers, I guess, have more power in terms of their ability to command the best deals and the best terms and conditions associated with that. But also, once the defaults occur or
just a question,
the issue occurs.
So on marks, good to explain to the audience, I think, the technicalities of the way they mark their investments, they value their investments. And how do you check?
Well, I think
how does JANA check on that?
Well, we don't actually do valuations of their investments. What we do is determine how they go about doing it. Right. And one of the points that ASIC has made recently with their determination on, or their paper on this sector, is that there's quite a wide and perhaps disturbingly wide approach to valuation in this space. And it's not clear that it's all arm's length. And so this is one of the things that we would look at. How do you actually go and value your asset book? Do you get independent valuation done? Obviously, this is going to affect unit prices, but you often find in this space that there might be inter-fund transfers occurring. Are they being done on an arm's length basis. So where the conflict of interest management is occurring as well in this space. So valuation, I mean, this is not just private credit.
Oh yeah,
And I think we've got to be careful that, talking about the compression of spreads, the valuation approach is not just private credit. We've seen a general compression in credit spreads in the public market, private market. I mean, that chart on the left-hand side there, private credit is the top line. What we're seeing at the bottom there is leveraged syndicated loans.
It is a highly sophisticated industry, and you need people who know what they're doing to analyse these fund managers, right?
Yeah, and what I was saying before, once you do get defaults in this space, then the question is, does the fund manager have the actual capability to work it out? Because it's still on their books. They still have to realise value. So the ability to actually manage that problem loan through to completion is a fundamental requirement for fund managers. And it's not clear to us that all the fund managers that have entered into this space have that capability.
Yeah, I mean, an issue in retail is that you see portfolios put together all up 2 or 3 funds only. So you've got to be pretty spot on, right, in making sure you've got good funds to make that work. I mean, is a more diversified approach, appropriate?
I think I brought one slide, so that's how much I like this slide. So this is the dispersion of returns on funds in the listed equity market, listed fixed income market, listed real estate market on the left. So they're the listed stuff. That's the stuff a lot of you have in your portfolios for clients. A lot of you might have a consultant helping you pick the things on the left. But what we see in the industry, ironically, is that a lot of advisors get a consultant to help them with what's on the left, but then go DIY on the right. And on the right is the dispersion of fund returns in private markets, private equity, private credit. And you see that dispersion, and the fact that once you're you're locked in forever. The question is this where you want to be doing DIY? If either side you're getting consulting and help and professional advice to build a diversified portfolio, it's probably the right. So that's just a little plug for obviously self-promotion there, because it feels like we've got to be onto that, and we notice it's often the other way around.
Okay, Michael, looking ahead, what will actually drive private credit asset class returns, short and medium term? Is it macro factors such as interest rates, economy-driven defaults, which we just talked about, or simply manager selection?
All of those. As Darren pointed out, manager selection is absolutely critical, as per any other private asset class. Determining the best managers in this space is going to deliver you the best performance and probably the best protection for your portfolio, assuming that they have the appropriate due diligence process to pick the right sort of loans. So that's absolutely critical and needs more focus. The macro environment feeds into the question of defaults. So probably the biggest threat to credit generally, be it private or public credit, given that credit spreads have come in a long way over the last few years in the hunt for yield, is going to be a significant uplift in default rates, and that is going to be driven, because these are largely corporate loans, it's going to be associated with a deterioration in the economy. So if we were to get a notable recession in the major economies and an escalation in default rates, that's certainly going to have an impact in this space as well.
Right, and Darren, we've seen listed vehicles trade at big discounts in stress situations. What should advisors take away from that, and how might ASIC's governance focus change behaviour?
So you have your listed vehicle, whether it's an Australian listed investment trust or listed investment company or a US BDC. You can go on Bloomberg and hit the NAV, and you can see what the traded price discount is to the NAV, and that we literally get that up in our investment committees to see how fearful the market is about what's going on in private credit. And when you look at that discount, let's say you look at one household name, MXT, is a listed version of Metrics, and you see that discount blow out to 8%. What does that mean to you, or what does it mean to us? there's two parts. There's the NAV. Is the NAV wrong? Or are people just running to the door and happy to take a discount to NAV, knowing they're taking that discount just to get their liquidity? And it's obviously very hard to decipher between those two. But I'd say most of the time it is a contagion effect of fear that the people going into listed versions, BDCs in the US, listed investment trusts in Australia, are doing so thinking this is a really easy way to have illiquid assets in a liquid format. But then, when there's any sort of fear in the newspapers, the AFR is printing headlines about things not great. That's when you unpleasantly go to sell that and get that discount. I'd say it's more a measure of fear than actual mis-NAV, but what ASIC will do is try and get that NAV cleaner so that people have greater confidence, transparency, arm's length valuation. So then you shouldn't see the discount to NAV be more about people questioning the NAV. It's probably just a genuine liquidity issue and people are happy to take that discount to get out, is what I'd say.
Okay, sort of got a few more minutes. So just to summarise, start with Michael. So what's your sort of summary view of this asset class, particularly for Australian investors in the next few years? And would you be overweight, neutral or underweight, or have a strategic or a tactical position in terms of recommending to the so-called typical client?
Yeah, I think the nature of the asset class is that tactical positions are very difficult. So I think you have to look at it as a strategic holding within a portfolio. Look at the illiquidity budget of an individual client, what's their willingness to go the distance, and make that very clear to them that it's not an asset class.
So what's the term, so just maybe, what's the sort of typical term of maturity of these investments like?
All over the place. I mean, you're buying a pool of assets within a fund, so you're going to get a range of terms, as you would with private credit. The distinguishing characteristic is that they're based on floating rate rather than fixed rates. So, the level of return you'll get will rise and fall with central bank policy. So in Australia, for example, the Reserve Bank's raised rates a couple of times. You're going to get an uplift in terms of interest rates that are flowing through these funds that are domestically orientated. But the maturities can go from 3 years out to 5 years, on average in this space. In terms of our view on private credit, we have been overweight. We've actually just pulled it back to neutral. We still like it as an asset class, but we are concerned about the number of fund managers that have entered this space. We think there's a wide dispersion in capability and hence the outcomes you're going to get from investment in this space. And we think that, it's really a case of being very careful about not positioning it in portfolios where ultimately there is going to be some requirement for liquidity.
Okay,
so,
good. Darren, how are you guys positioned?
With the caveat, we're positive, but we're positive on a global allocation. I think you've got to really remember diversification is key. Holding one or two funds, all exposed to mostly Australian property, is not a great diversified portfolio. There's amazing opportunities in Europe and the US and the rest of the world. Access is key, so work out how you're going to get the best access, because you can't just jump on a platform and buy a fund to get the really great opportunities globally. So whether there's many out there, but work out how you're going to access the best funds in the world under the right tax structure, under the right fee structure. And we're really positive, once again, fund by opportunity, not just a one size fits all.
Okay, thanks. So we'll just take some questions from the audience.
Questions?
Got a few minutes.
Hi, thanks, Nigel. Mark Oliver from iCapital, and we actually structure and issue pretty much most of the world's private credit funds. Probably a question for Michael, and that is, so if we look at the dispersion of managers and you've chosen a blend of managers, how do you ensure you're getting true diversification when you put two managers together with a potential portfolio where there's overlaps in the loans that they hold?
Yeah, it's interesting. I attended a conference a couple of weeks ago where people were asked about domestic investment versus international investment in this space, and most said that they preferred to keep it domestic. That's an interesting phenomenon, because I think Nigel, you quoted some figures that 50% of the domestic private credit market
According to ASIC, that one.
is real estate. I'm not sure that you're getting true diversification from that. So I think fundamentally at the outset, we would suggest that, similar to what Darren said, that you look maybe for a diversification of maybe 3 managers, if you can, but one of those only, perhaps domestic. Look for international diversification. You can get US-based funds very easily, but we're seeing increasingly European-based funds as well. So you're getting geographic diversification there, and obviously there's sectoral diversification that goes with that, because the US funds do have an exposure to technology, which is obviously very topical at the moment. So I think it's looking at that geographic mix and where the managers are sourcing their loans. But importantly, picking up the point that Darren made, this is a space that, more than most other spaces, you need expert advice on. It's under-researched. There's a lack of quality research in this space. And so getting the right sort of advice in terms of picking the right combination of managers is essential.
More questions?
Perhaps for Michael. If you come to the view that a fund or a group of funds is likely to gate sometime in the sort of short, medium-term future, what are the issues or factors that you would consider in deciding whether to recommend a redemption is put in or not?
I got a good quote about this. It's the prisoner's dilemma. When you know you're in a fund that may gate, it self-fulfills itself, because every investor in the fund is faced with the same question. Do I run for the doors now, or do I stay and get left holding the turd, was the actual quote. I'm not sure. And then that self-fulfills. Probably, Blue Owl's an example where it wasn't a default issue so much as a run for the door issue. And once you know the money's starting to trickle out, then that makes the rest run. And I think in Australia, that's a real risk. That was a real risk in our heads, more than the actual default risk of some funds, I won't name the names in Australia, of this prisoner's dilemma, that the fear self-fulfills itself rather than the actual defaults.
The analogy, it is very much like a bank-run situation, which of course we saw during the GFC, that it does become self-fulfilling. I would say that what you really want to probably assess is, do you actually have an underlying portfolio of turds, or is it actually a reasonable loan book? And if it is a reasonable loan book, why are you rushing towards the door? That's where the opportunities potentially lay. It may be a case of, is there an opportunity to actually top up investment at this point in time? But the fundamental issue is you're not needing the liquidity. If you're investing in this space and always need to have that option to get out the door, then you probably shouldn't be investing in private credit.
Yeah, I do. In the example of Blue Owl, they waited 3 months or so before gating the fund. So those investors who got out are now on to their next thing. Yeah, and then the investors left in there have a workout situation over the coming years, perhaps. So I think even if the underlying investments are good, the manager's naturally going to carve out the most liquid stuff first to give to their redemption queue. It's a really difficult situation, I think, to be.
It is, and in that sense, it's almost they're doing you a favour if they gate it quickly.
That's right. Yeah.
Because then you don't have that situation that the best, most liquid or the most attractive assets are sold off, and you get left with a rump that's far less attractive. In that situation, I would rather them gate it quickly, prevent that rush, and then you actually have a better loan book underneath.
A story, when I was working at my previous firm running super funds, I had to gate a fund because there's a mass exit of other super funds that invested their sustainable product in the product does. And it was amazing, the call saying, sorry, redemptions are shut, we're gating the fund. Half of them said thank you for that, because we're worried what we would need to do to not be left with the crap at the end and overly liquid allocation, we knew the fund was an outflow, so this is great news because it means we're going to get the fair exit. So it's interesting when you're speaking to institutional professionals how they appreciate the gate because it is about equality.
Yeah, well, it's a bit of a pessimistic note to end on, but we are saying it still is a viable sort of innovative sector, but there's really got to find true quality managers, and they will tend to generate higher returns on a better risk-adjusted basis than the lower quality managers. And you probably need an expert to help you out. I think that was the other conclusion.
Nigel, before, you've got 2 minutes, I've got one question.
Yeah, you got a question?
Secondaries?
Oh, yeah,
I look at this space and go, okay, in an environment where there's potentially interesting dislocation in a market, if you've got someone with the intelligence and capability and dry powder, that's actually an interesting combination. So have you thought about secondaries in this space? And if so, where are the better managers?
I'll let Darren.
Oh, yeah, we love secondaries. In 2024, 2025, amazing discounts on really high quality private credit in the secondary space. The reason that is because a lot of US pension funds got a bit excited in the 21, 22 kind of private bubble that happened, or bubble, exuberance, overextended themselves. Then a lot of funds stopped paying distributions in 22, 23 when it got worse for a little bit. And then these pension funds were left with no distributions coming back in, overcommitted on things, and they just basically had to sell stuff at a discount. So really good opportunity to make returns. They're hard to access and managers charge a fortune for them. A good secondary fund costs an arm and a leg. So we're trying to diversify that. The interesting thing about secondaries as well is the second you get them, they market up to NAV, which like you get something at a 10% discount. Maybe that's a liquidity discount, but maybe it's got a couple of warts in it and that's why they're selling it. But to get this thing right, it's straight up to discount and that's the new NAV seems a little bit off, but that's how the world works. So we try and offset that in the fund with stuff with J-curve, which is the other way. You get something, you don't write up any value for 18 months because it's private equity co-investment and then it pops. So if you have this nice mix of that, you can kind of smooth out the return. But if it's all secondaries, there's a bit of an artificial expansion in returns in the early days, which might be real or not.
The other interesting thing about this space...
Running out of time. Yep.
Sorry. The other interesting thing in this space is that there's actually a lot of dry powder sitting in a lot of these funds as well. So we're seeing the retail funds under a lot of stress because that's where the redemptions are occurring. But elsewhere in the private credit space, there's actually a fair bit of dry powder in uninvested capital, which can take advantage of this environment as well.
Okay, I think we've finished our session. So
Yes.
thanks, Michael and Darren.
Thanks, everyone.